Piet Viljoen, founder of ReCM, and the only keynote speaker to have spoken at all of the Biz News conferences. That includes the investment conferences as well. And he's going to be back again in March. Well, he's here to give us the benefit of some of his wisdom today. Piet, I'm a fairly late arrival to your monthly newsletter that you send out. Volume 4, I see, is the latest one. So that would presume that it's been going for 4 years. You're very personal in there. You expose yourself to the world, which I think psychologists will say a really good thing because it makes you vulnerable and lets you engage with people. What drove you to do this in the first place?
Yeah, I think the main thing is I've always written about investments, and I just decided to start writing about it publicly because it helps one in two ways. Number one, very important, it holds you accountable for your thinking and your decisions in public. I mean, if you think about your decisions and make decisions in public, it holds you accountable. As they always say, sunlight is best disinfectant. And the second thing is, it is, for me, it's a way of thinking through problems, investment theses, stocks, that sort of thing. I start writing about it. And as I write about an investment problem or an investment thesis, I start discovering the holes in that argument much more clearly than when you think about it in your mind. Because when you think about it, you tend to sort of just gloss over the holes in the argument and think you've got it sorted out. But when you speak about a proposition or you write about a proposition, it tends to uncover those holes for all to see. And I think I found that very useful.
Do you come from the other side as well? As we remember Charlie Munger used to talk about invert, or Tim Noakes talks about if you've got something you really believe in, well, try and argue from try and disprove it. And that way you'll eventually end up with a far better thesis.
Yeah. So when I have something I really believe in, I try and steel man the argument against it. And when I have something I don't really believe in, when I sort of just dismiss something, I try to storm man the argument against it, try and see if I can destroy that argument that I hold. So I try and work both angles from the opposite side. And that's what I try and do in the writing, because at the end of the day in investing, things are never clear until they've happened. And in the rearview mirror, things are obviously very clear at all times. But before things happen in the markets, things are very unclear. And the best you can do is try and get the odds on your side through thinking consistently through things and accept that sometimes you're going to get it right and sometimes you're going to get it wrong.
Well, right now, many people are very confused, primarily because there's a guy called Donald Trump in the White House. And I had a fascinating thesis that was presented in an interview by Neil Ferguson, the great historian. Yes. He said that Trump is applying the madman strategy. He gets everyone to think that he's insane, and that way they back down and let him have what he wants. Do you think there's any truth in that?
Look, I mean, he's always said described himself as a deal maker, and what he's doing is the art of the deal. And one of the things in deal making negotiations, one of the first things you learn is you have to sort of put the pen in the ground very far in excess of what you want, so that when you start negotiating back, you can possibly end up in a better position than you had hoped for at the outset. And I think that is, it's the same thing as the insanity type argument, is that you go crazy, you say all sorts of things, and they end up in a position better than you started out, but not as extreme as you were talking about.
So let's look at Greenland as an example. The whole of Europe is a titter by the fact that Donald Trump has said, we want Greenland. We will acquire it And I suppose there are people saying, well, he is a real estate guy and this will be the biggest real estate transaction in history. So maybe that's something he wants to put on in his epitaph. But do you think that he's really just trying to get the Europeans to help him to defend it against who he perceives, not perceives, his enemies, Russia and China?
It's very hard to think of a rational reason for this. It could just be that he wants to become known as the president that acquired the 51st state. Just have that on his CV, so to speak. It could be as simple as that. Or it could be, that there are possibly, and I don't know this, but there are possibly rare earth or lots of rare earth minerals in Greenland that the US can exploit to rebuild its supply chain into the defense industry and that sort of thing. That it could be strategic for that sort of reason. It could be strategic just from a geographical point of view, as you point out. There's any number of reasons why you would do that, but I don't think that we wouldn't know. It's as you say, he creates massive uncertainty and exploits that uncertainty. And again, I think it makes investors uncertain as well.
So he's put a stake in the ground far in excess of what he really wants again. And we just need to read him that way. Do we give people like Trump and politicians generally too much headspace? Our headspace?
I think so. I think politicians tend to reflect what the popular vote wants them to do. The popular vote isn't always right. Popular music is always the best music, and so on and so forth. But they just reflect popular opinion. And I think when you're looking at investments, in the short term, yes, politicians can have an influence on investment outcomes. But in the longer term, I think they have less of an influence than we would give them credence for in the general discourse. I think there are much more important things at play in determining investment outcomes than what somebody like Donald Trump does, or Joe Biden, or all these people. We've forgotten about Joe Biden. I mean, did he have an effect on investment outcomes? I don't think so, but he had a lot of newsworthy moments while he was president.
So let's look at South Africa's newsworthy moment. 18 months ago, we have a government of national unity installed. At the time, the South African stock market was on its knees. The rand was very fragile. We forget this. Piet Viljoen said, great buying opportunity, one of the best that you'll see. And, 18 months later, things, as far as investors are concerned, have worked out very much in the favor or in the suggestion that you gave. But what about this government of national unity? It's had many threats. It continues to go forward. Is it something that you are paying a lot of attention to, or should we be doing so as well?
Again, I think the major benefit of the government of national unity is that it is a government that struggles to make any decisions, struggles to do anything, and the less government one has, the better. And I don't think we have much government happening in South Africa right now, so I think that's a good thing. I think that's a good outcome. I think it's probably of interest to see what the government is doing, what they're saying. But is it going to change anything fundamentally? The less they do, the better. So I think that's a good, positive, fundamental change that's happened with the government of national unity. But otherwise, other than that, I don't think so. That's not my view.
And South African shares have really had a fantastic year. I watched the EZA. It's the South African ETF listed on Wall Street. And that's gone from around 50 cents to over 70 cents. So easy to calculate, more than 40% in the past year in US dollar terms. It's been a very good year.
It's been a great year. There's been a combination of things happening. First of all, local share prices and the price of bonds have gone up a lot by 20% plus in Rand terms. And then you add on top of that a 15 to 20% appreciation of the Rand against the US dollar. So that adds up to 40% plus very easily for most South African assets. So it's been a banner year for South African assets. And nothing really has happened. There's been no real fundamental change except for two things. And I think these are the real fundamentals that one should be paying attention to, as opposed to politics. The one thing that has happened is the prices of precious metals has gone up a lot. Gold, platinum, and silver. Okay, we don't produce much silver, but we produce a lot of gold and a lot of platinum, and that's good for our balance of payments, which ultimately is good for the currency and good for economic growth. So I think our prospective growth rate is better than it otherwise would have been. On top of that, our interest rates have come down from exceedingly eye-wateringly high levels, bond yields of 12, 13, 14% even at one point, to bond yields of 9 to 10%. So that's a 4% reduction in your risk discount rate. So we've had two positive effects. The future cash flows that South Africa as a country are going to generate, which South African corporate share in, are higher than they otherwise would have been, given the precious metals backdrop plus low oil prices, which also helps. Those cash flows are bigger, and you're discounting those cash flows with a lower interest rate, which means the present value of those cash flows are a lot higher. And that's been starting to have been reflected in the prices of assets in South Africa. I don't think it's fully reflected, but the process has started.
How far along that trail are we, saying that it's started to be reflected?
I think when people start getting excited about South African assets, then we'll probably have fully reflected most of the prospect benefits. Bearing in mind that our interest rates, even though they're 9 to 10% for bonds, long-dated government bonds, that's still a very high interest rate. Our inflation rate is similar to that of the US, in the region of 2.5 to 3%. Our bond yields are 9%. US bond yields are 3.5 to 4%. That's a massive premium we're being paid to hold South African assets. And while that premium is in place, I'm a happy holder of more South African assets than I otherwise would have had in a sort of balanced portfolio.
Well, that, for outsiders, would presume that South Africa is not being that badly managed relative to the United States. Is that a fair assumption?
Well, we have had very high interest rates, which has discouraged lending, which has discouraged money printing. So it's by force of circumstance rather than conscious policy choices, I would say. I wouldn't trust our government to make fiscally responsible choices in the absence of constraining factors like very high interest rates.
Okay, so you're not going to give me an 18-month scorecard for the government of national unity, because I think if I hear you correctly, yeah, it's fine. Whatever. That's not really
the less the better. The less the better.
Yeah, let them keep fighting. Let them keep disagreeing, because less government, the better it is for us in the real economy to get going on. But I'm sure you can give me some insight into the way that you see the MAG7, the tech stocks in the US, with South African shares. Now, there's the difference between the two has definitely narrowed over the past year. South African shares have outperformed the MAG7. Is this something that we can expect to continue?
Look, to the extent that valuation determines investment outcomes, which it does to a large extent, I think we can continue to expect this sort of trend happening. As we've been speaking about for a number of years, 2, 3 years, 4 years now, South African assets are fundamentally undervalued, and they're fundamentally under-owned by South African investors and by offshore investors. I think emerging market investors are very underweight South Africa, and South African investors have been listening to advisors telling them to take their money offshore as fast as they can, as much as they can. So they also have very little exposure to South African assets. So it's undervalued and under-owned. So I think the combination of that, with the backdrop of improving fundamentals in terms of lower oil prices, higher precious metals prices, and lower interest rates, I think argues for continued good performance from South African assets. On the other hand, US assets are massively over-owned. The US makes up over 70% of the NCI world, whereas the GDP is probably only about 40%, if that, of the world. So it's massively overrepresented in the index, and investors are overweight the US. So I think it's over-owned and overvalued. So you have, on the one hand, over-owned, overvalued assets, on the other hand, under-owned, undervalued assets. And I think that argues, in the absence of anything else, that the undervalued assets should outperform, as they have been doing now for 18 months. And also, the other problem with the MAG7 is they are software centric, and software until recently was the big flavor of the world. But I think AI is starting to take over that flavor, it's starting to replace that. And people are saying that you don't need software companies anymore. Like Microsoft is fundamentally a software company, and you don't need software companies anymore because you can code it yourself using AI. So, that flavor is starting to shift a bit. Whether that fundamentally is right or not, I can't argue a point. I don't have enough knowledge about that sort of thing. But that is the argument that's being developed out there in the market right now.
I came across a very interesting paper by a couple of academics, Xavier Gabay of Harvard and Ralph Koijsen of the University of Chicago. And what they argued made a lot of sense to me because it has been quite difficult to understand this continued excessive valuation of US stocks in particular. And they say that at the moment, it's all about the flow of funds. And they, by looking back at their, through a lot of research, they said for every $1 that's going into these companies, $5 is being added to their market cap. I mean, that's an extraordinary number because people who own the shares are not selling the shares or not selling them in the same volume. So if you're wanting to buy those or to acquire those shares, you've got to pay up. And the people who are buying the shares or the organizations that are buying the shares don't actually care about the price because they're exchange traded funds, they're institutions with required mandates. And these academics are saying that's what's driving the share prices. It's the flow. It's almost like you've got a guaranteed buyer who doesn't care what the price is because it's an ETF. An ETF says you have a certain percentage of that share, and you've got to buy the share whatever it's trading at. And as a consequence of that, valuations have now become less important in what determines share prices. For the first time, a little light went on for me. Obviously, it will lead to quite a lot of pain in due course because the $1 equals $5 up would suggest
Also
that when
goes
that $1 gets pulled out, it's going to be $5 down. What is this thesis? I don't know if you had a chance to read through it, but what does it mean to you?
I haven't read that article, but I fundamentally it makes sense to me. As the world has moved towards indexing, especially in developed markets, money has been removed from active managers who are underweight the large caps and overweight, the stock pickers always overweight the smaller companies and the ones where they can see value. So money's been taken away from them. They've become forced sellers of the things they own, the smaller companies, the value stocks and that sort of thing. And that money is moved to the index, and the index obviously indiscriminately buys according to the index weights, which is Nvidia, Microsoft, Apple, and so on and so forth. So there's been a distortion happening in the market where the large have been getting larger and the small have been getting smaller as a result of these flows that you talk about. And this can carry on for a long time. As the old saying goes, markets can stay irrational longer than you can stay solvent. So it's betting against that trend has been not a profitable strategy, but it does reach a limit at some point. And you can already see emerging markets have now started outperforming developed markets the past 18 months. South Africa, being an emerging market, has taken part in that outperformance. And I think it's a matter of time before the flows start. Because remember, investors tend to look in the rearview mirror saying, what's done well over the past 12, 18, 24, 36 months? And they start backing those assets. Up to now, there's US exceptionalism, so all the money has gone into the US, but that is starting to reverse. If that continues for another while, I think you can see those flows that you talk about reversing out of developed markets into emerging markets. And this has been my thesis for quite a while, is that we are on the cusp, I think, of a long-term bull market in emerging market assets because the fundamentals are undervalued, generally speaking, emerging markets, underowned, and much more responsible financial management, both monetary and fiscal financial management in emerging markets relative to developed markets. So you've got fundamentals improving, you've got undervaluation, you've got under ownership. I think it sets the table, sets the scene for a long-term cycle in emerging market outperformance. Of course, interrupted by ups and downs in the short term, but I think if we look back 10 years from now, you'll find that emerging markets have actually done very, very well.
That's an interesting thesis and very different to what you would hear generally. But something in our daybreak, what I get up, been a member of the 5 a.m. club now for some years. And so I get up in the morning and then put together our daybreak program, which I'm thoroughly enjoying doing, and we're getting really good traction on it. But this morning, there was an interesting addition in the Bloomberg report that we carried, the overnight Bloomberg report. And that was that the Russell 2000 index, which is the small caps in America, has outperformed the S&P 500, the bigger caps, for the last 11 consecutive weeks. Now, that's something that hadn't occurred to me at all, but it might also be something else that's adding to this idea that, hang on, nobody rings the bell at the top or nobody tells you when things change. But if you are able to read the wind, you mentioned the emerging markets. This with the Russell 2000 index outperforming the S&P 500 might suggest that the change is actually happening and we might not be fully comprehending it.
It could be. I mean, all these assets tend to move together. Small caps, value stocks, emerging markets, metals, resources, they all tend to move together as opposed to large cap, software, AI, all that sort of stuff. These things tend to move together. So to the extent that emerging markets are doing well, South Africa is doing well, metals are doing well, I'm not surprised that US small caps are also doing well, relatively speaking.
What about this story that Magnus Haystick was talking about when we spoke last week about a melt up of all asset classes in the past year? He said 2025 was a spectacular year. He can't remember anything quite like it, where just about everything went up.
Yeah, I think as usual, Magnus is spot on when he reflects on what's happening in the market. We are, I think Gavcal research calls it an inflationary boom. Western governments worldwide are sort of printing money to alleviate the debt situation in those countries, because the debt situation is out of control in a lot of countries, developed markets, that is. And that's leading, and also this reshoring of the supply chain leads to increasing demand of metals, the sort of stuff that emerging markets produce. So it all works together to get to this force where everything starts going up in dollar terms. Of course, if you measure it in hard currency, real hard currency, gold terms, then it might not look as good. I think equity prices priced in gold terms has not gone up as much as equities priced in US dollar terms. Just like equities priced in rand terms have not gone up as much as equities priced in dollar terms. And that's more a function of dollar weakness and money printing in dollars.
And I guess in Bitcoin terms as well. You still have your Bitcoin? You still nibbling away there?
I mean, my view is, let me take a step back. I don't have a strong view. I think there is a good chance that Bitcoin and the associated blockchain with those cryptocurrencies fulfill or replace a lot of what we see in traditional finance. I think there's a good chance that happens. If that happens, then Bitcoin and other cryptocurrencies will be worth a lot more than they are today. But again, as with all investing, that's not a certainty. It might not happen. So would I have a huge exposure to Bitcoin or cryptocurrency? Let's call it cryptocurrency, because Bitcoin is one of them. Would I have a huge exposure to it? No. Just like would I have a huge exposure to South Africa, seeing I believe that South Africa's undervalued under-owner will do well? No, I won't, because it remains a risky proposition. But I would have more than I otherwise would have had in the absence of these fundamentals.
Piet, you focused on banks for a big part of your early career.
Yeah.
And something's been baffling me. In South Africa, financial services, people who work in financial services seem to be paid quite a bit more than everybody else. It's almost like the banks have really had it good for a long time. You look at these CEOs of banking companies, and it's nothing for them to earn 50, 60 million rand a year. And you wonder how they can be adding that amount of value to the bottom line of that organization, given some of these people that I've met I'm not so sure I would be employing them. So it really is a strange scenario that we have here, where financial services companies are really coining it in this country. And yet you've got the technology that will be threatening them. You've got so many things coming at them. I want you to give me some insight on Pepcore in just a moment, on their financial services moves. Are we at a maybe a turning point there, or are you still excited about South African banks as an investment?
Yeah, I mean, there's again, as with all investments, there's two sides of the argument. Yes, banks are inherently quite profitable. Returns on equity are generally in excess of the cost of equity, and you add leverage to that, then it helps. So they're in a good position. The incumbents are in a good position, but they are being attacked because of their profitability by outsiders like initially Capitec, now places like PEP, and eventually places possibly, blockchain could also attack the incumbent financial players. So they are being attacked. But the other side of the argument is in South Africa, the market is not very deep when it comes to being banked. There's a lot of people out there. There are a lot of people out there that are only peripheral to the financial system and can still be drawn into the system. So I think there's still a lot of business to be done out there, given the right infrastructure and given the right product. So I think one can be optimistic about these new players like Time Bank and so on, who are coming into the market and attacking the underbanked or underserved portion of the market. So I think there's still growth out there. And also what one has to bear in mind about the banking system is it is hard to move your bank account. It's not an easy thing to do. There's lots of forms to fill in, lots of regulatory hoops to jump through. You got to change all your debit account, all those sort of debit orders, all those sort of things has to be changed. It's not easy to do. It's not simple. So banks tend to have sticky customers. So what happens is that you start splitting your business between this bank and that bank, but you don't move away from that bank. So from your principal bank. So they've got sticky customers, which is a useful asset. On top of that, because of the high level of interest rates in South Africa the past 5 to 10 years, people have not been borrowing a lot of money. I mean, I think as a whole, South Africans are under-borrowed. So the banks are not vulnerable to a bad debt cycle at this point because they haven't been lending out a lot of money. And I think the money they have been lending out has generally been of a fairly good credit standard because the banks have been quite conservative after the financial crisis of 2007, 2008. Capital requirements are higher and so on and so forth. So I think the banks fundamentally, the balance sheets are fine. The income statements for now are still fine, despite the attacks from the upstarts. Over time, of course, they'll probably grow at a lower rate than they otherwise could have grown. But I think given the current pricing in the banking system, I think they still make for good investments with that background.
And their dividends are also very appealing as well.
The dividends are appealing and well covered, but executive remuneration, that's another story. That's a big bugbear of mine. As you follow my writing, by the way, the newsletter is a weekly letter. It's not a monthly letter; it's a weekly letter.
Apologies.
You'll see. I'm every now and then I take an example of egregious executive remuneration. It's a massive problem.
Well, what I did was I banked a whole bunch last year of your newsletters and then read through them during the holidays, and I was under them. It's quite an achievement to do that on a weekly basis. So your first one has just arrived. Love the quote from Cicero. Just repeat the Cicero quote.
The Cicero, which one was that? Just remind me, because I had one by Munger there as well. Cicero, which was that quote?
About it's about something to do with...
Oh, yes, about history. If you don't understand history, if you don't study history, you'll stay like a child. So to that extent, you won't develop, you'll stay like a child if you don't study history.
In other words, there's so much to learn in your development as a human being. And a lot of that is to learn from what's happened before you, from dead guys.
And I think the context in which I used it was to say that the best way to prepare for the future is to study history and not to make forecasts and look at other people's forecasts and expectations, and just study history Study what happened in the past, what worked in the past, and apply that in your preparations for the future.
So I love Neil Ferguson's writing and certainly the stuff that he's talking about.
Very
And
much
this
so, yeah.
madman approach. He said it was Richard Nixon tried the same thing and couldn't get it right because the Russians didn't believe he was a madman. But it seems like Trump is getting it right, he was saying. You've also removed yourself from Twitter / X.
I have, yeah. I have.
And the consequence of that?
Lots more time for reading and writing, which is fundamentally a fabulous outcome. And I haven't regretted it for 1 second.
What drove you to that, though?
I just found that I was wasting time, as I say, doom scrolling, and it was just a complete time sink for me. And I think I wrote in my newsletter last week that last year I managed to read, I think, 13 or 14 books, which is double my previous year's number. And that was with 6 months less of Twitter or X, 6 months less of X. So hopefully this year I can read even more books. And I think a lot of the books I do read are history books, which I think is I enjoy very much more than doom scrolling X.
And your target for the books, you get a number of books this year?
Well, I think I did say in my letter that I'm not publicizing my goals this year because I did last year and I failed in most of it.
Well, I've got two for you.
But more than last year,
I've got two goodies for you that I've been reading during the holidays. One is called Nexus by Yuval Noah Harari. It's superb. It's about the development of AI and communication from the Stone Age through it. It's really a good book. And the other one is called the Chip War, which is all about semiconductors.
Yes, I've heard of that one, yeah.
It is phenomenal. It is an eye-opener of note. And then you will buy ASML, I'm sure. David Shapiro told us to buy ASML all those years ago, and it's done well for us in the portfolio and just keeps going higher and higher. It's like a monopolist on the machines but when you read that, you get to understand, or I certainly got to understand, why they have this technological advantage. But overlaying all of that, and a big part of the chip war, is TSMC, the golden shield of Taiwan, which may or may not still be a golden shield into the future. Now, you don't want to talk about geopolitics and that kind of stuff, but surely that's got to be something to look at.
Look, it is. I'm optimistic about the prospects for investing in China. I think it is, again, it's under-owned and undervalued, as opposed to five years ago where it was overvalued and over-owned at that point. And then all of a sudden it became uninvestable for people, and now it started to pique my interest. And so the big risk with investing in China is if they invade Taiwan and then there's sanctions and the war and all that sort of stuff. But I think if you look at the history of China, you'll find that they have not been militarily very aggressive at all throughout their whole history. They tend to subsume other areas rather through a slow process of, I want to use the word amalgamation. That's quite, I can't find the exact right word to use. Assimilation, slow process of assimilation rather than outright a takeover through a process of war. I think that's their history over time. It might be different in future, but again, I'd rather bet on how things have worked in the past. They'll continue to work that way in the future. So I don't expect them to invade Taiwan and to take it over through means of war. Of course, that'll probably start happening tomorrow, just because I said that.
Well, Piet, it's been, as always, a privilege having a chat today. Look forward to speaking to you again before we see each other in March and Hermanus. Have you got something up your sleeve to share with us then?
Not yet. I still need to apply my mind up, but I'm sure something will come up. And I do find, again, that conference fascinating. So I've been privileged to attend all of them. And for me, it's very insightful hearing what other people have to say about what's going on around us. So I think for me, I love being there so that I can attend the conference. So it's fantastic. Yeah.
Well, from our perspective, it's very insightful, always, what you have to say. And Piet Viljoen is the founder of ReCM. He's the fund manager of the Merchant West Value Unit Trust. And before he leaves, I was interested to see that you and Jan van Niekerk are still in your letter. You still write about Jan. How long have you guys been partners for?
Well, Jan and I have been partners since 2012. 2012, I think it is. So it's 13, 14 years now. Yeah. And myself and Tienus de Bruin have been partners for 22 years now.
And there's another Van Niekerk who's in your environment.
That's Rudy, who co-manages the value fund with me, Rudy Van Niekerk. He has a fund called Desert Lion, which is a US Delaware domiciled fund that invests into South Africa. So he sells that fund to US investors, and he also co-manages the Merchant West Investments Value Fund with him.
They must love him. That Desert Lion fund. It must have done real well this last period.
It has done. It's had 2 fantastic years, but it's still hard to get US investors interested in South Africa. But it's going to happen. I have no doubt it's going to happen. The sort of numbers Rudy's putting on the board, it will start happening.
Piet Viljoen, good talking with you, and I'm Alec Hogg from biznews.com.